This is the study session on equity investments and the final reading on equity valuation. And this is really the reading that we've been waiting for inside of this study session. The previous 5 readings have kind of set ourselves up for this one here. We're going to do some calculate. But here's the context. I want you to think about this. As good financial analysts, when we go to the floor of the New York Stock Exchange and we observe a market price, we have to ask ourselves the question, do we like that market price? Do we think it's fair? Do we think it reflects all relevant and publicly available information? It's no different than buying a car. When you go down to the car dealer, you look at the car and you drive it around, you see it has an engine and has tires. I'm not much of a car guy, but if you don't like that particular car, you can ask for another one. If you don't like that particular price, you can go to another car dealership. And if you don't like the price, if you don't think the price on the floor of the New York Stock Exchange is fair, well, then you go somewhere else. You look for other companies. And that's really essentially what we're doing inside of this reading. We're trying to make certain that prices are fair. And there are 3 ways to do that. Let's go ahead and start on those 3. All right, the first LOS asks us to evaluate whether a security, given its current market price and value estimate, is either fairly valued, overvalued, or undervalued. Now remember, in the efficient markets hypothesis reading, we were taught that these founding fathers of finance believed heavily in stock market efficiency so that prices reflect all relevant and publicly available information. We called that fair value. But sometimes we know, for whatever reason, maybe there are some behavioral issues, that stock prices creep up a little bit too high or they creep down a little bit too low. So here's where we have to introduce the concept and remind ourselves of the concept of this intrinsic value. Remember how we talked about this in a previous reading. Intrinsic value is the core value, the basic value of a company. And we estimated that a variety of ways. But if in fact the market value and the intrinsic value happen to be the same number, we call that fair valuation. If the market value exceeds the intrinsic value, well, we call that overvalued. If we think that the stock is only worth 100, but it's trading on the floor of the New York Stock Exchange at 120, why would we pay 120 for something that we only believe is worth 100? And then, of course, with undervaluation, it's just the opposite. Now, the key part of all this is, what is our estimate of intrinsic value? How accurate can we be as good financial analysts in computing that intrinsic value? I mean, if we're computing intrinsic values and we have a standard deviation that's, this wide, then we're not very good at what we do. So what we're trying to do is estimate an intrinsic value that has a low standard deviation so that we know that we're accurate in our estimate, which makes then for a reasonable comparison against the market value. All right, so let's decide that we think financial security is overvalued or undervalued. Well, what do we do? Do we automatically jump in our car and run to the floor of the New York Stock Exchange? And we have to pause. So we're going to hit the brakes. We're going to pause and say, all right, how did we make that decision? What kind of assumptions were part of the model that we used to estimate intrinsic value? What kind of confidence do we have in that model? Once again, do we have a 5% confidence or do we have a 95% confidence? That's why the CFA Institute values that quantitative method so much, so that you can understand things like standard deviation and confidence intervals, so that you can apply those quantitative method concepts to the idea of an overvalued or an undervalued firm. Now, here are those 3 ways that I told you about in that very first slide. We'll do some present value models, and we'll take the present value of dividends or free cash flows. We'll do some multiplier models. I mean, the most commonly used is a price earnings ratio. And then we'll do some asset-based models where we're really just going to value the assets of the business. First one here, describe present value model. So this first one is called the dividend discount model. And there's a good old formula there that you're probably never going to use or you'll probably never have to memorize, but it's important to understand what we're doing is saying that the value the theoretical value of a financial security, that's on the left-hand side of the equal sign, is going to be the sum of all the dividend payments, of course the present value of all those dividend payments, plus the present value of what you expect to sell that share of stock for at some time in the future. So think about what I said, and let me remind you what I said in a previous reading. Look, what do we get when we lend capital to the executives of a business as shareholders? We provide this capital and we get a vague promise from those executives and the board of directors. They say to us, look, we're going to take your money, we're going to invest it in a positive net present value project. And if we're successful, we might pay you a dividend. So that's the numerator in that first part of the formula. We might get a dividend next year, we might get one in 2 years, and 5 years, and 10 years. And then at some point, the executives say to us, look, if you want to sell your shares, be my guest. Go to the floor of a secondary market and sell your shares. So there are two parts. You get income, which is a dividend, and you get the capital gain, which is the buy low and sell high. Inside of this model, we call that future selling price, the expected selling price, we call that the terminal value of the share of stock. So the value here, this is an easy formula. It's just the present value of the dividends and the present value of your expected selling price. How about we do a quick example? Let's suppose the dividends are 1.50 and 2 euros, and we expect to sell that share of stock for 20 euros at the end of 3 years. What if the required return is 10%? What is the estimated value of this share of stock? Now, let me just pause before I hit the next slide. Look, I'm giving you that 10% required return, but we're going to have to compute that at some time in the future. Let's take it now as a given, and then we'll swing back and figure out how to compute that thing. All right, so this is all we're going to do. Here, let me go back here. We're going to use this formula. That first part on the right-hand side of the equal sign is going to be the present value of the dividends. And then the second part after the plus sign is going to be the future selling price. All right, so notice what we have here. We've got 3 future dividends. We have 1 euro, 1.50 euros, and then 2 euros, right? And we're going to divide those by 1 plus the required rate of return. So we're just taking regular present value stuff that we learned way back in quantitative methods. So we'll divide by 1.1, 1.1 squared, and 1.1 raised to the third power. And then immediately after we get that last 2 euro dividend, we're going to run to the floor of the German stock exchange and sell that share of stock for 20 euros. So we'll discount that back over the 3 periods. So if you do all that, you get around 18.68 euros. Now, of course, on an exam question, it's going to take you way too long to do those denominators. So you're going to use the cash flow buttons. And those are the entries that I give for you down at the bottom. So make cash flow 0, 0 because nothing's happening today. Make cash flow 1, make cash flow 2, 1.1. Make cash flow 3, 2, plus the 20 euros. That gives us 22. Make the interest rate 10, and then solve for NPV. Now, here's the next question, is that for this model back here, this works really, really well for dividend-paying firms. But how about a non-dividend paying firm? I mean, let's face it, if you have a non-dividend paying firm, you put a bunch of zeros in the numerators, you're going to get a stock price of 0. Well, that doesn't make any sense because there are lots and lots of non-dividend paying firms out there, and they have positive stock prices. All right, so what do? How do we use this model? Well, the simple answer is that we just substitute something that all firms generate. And of course, all firms generate free cash flows. And in particular, we're going to use the free cash flow to equity. And we're going to substitute that free cash flow to equity in the numerator. Let me go back here. Instead of the dividends there, the 1, the 150, and the 2, we'll put free cash flow to equity per share in that numerator. And we can use this same model to come up with a price. And there's the good formula for free cash flow. Remember, you start with operating cash flow, or as the CFA Institute always calls it, CFO, cash flow from operations. We start with net income. We add non-cash expenses like depreciation and amortization, but mostly depreciation. Then we subtract out working capital. And then to convert that to free cash flow to equity, then we start with the cash flow from operations. We subtract out long-term investments. CFA Institute calls that fixed capital investment, and then add in net borrowing. And remember that net borrowing could be positive or negative. And so think about this. Let me just swing back here. And instead of putting dividends in the numerator, you just put the free cash flow to equity in the numerator. All right. So this LOS asks us to describe these major categories. So that's what we're doing. I use a little math to help us describe. All right, so let's go ahead and ask the question that I mentioned just a few moments ago. How do we get that required rate of return? Well, what we could do as good financial analysts is use several models that are out there. We could just go out and interview the shareholders and say, hey, by the way, for you to lend capital to this particular company, what interest rate are you going to charge them? Well, that doesn't make much practical or pragmatic sense. Why don't we go back to 1964 and use the William Sharpe capital asset pricing model? Remember, William Sharpe developed this model because he learned a bunch of stuff from Harry Markowitz and said, you know what, let's define the expected return on a share of stock as being a function of a couple of market variables. Are you ready for this? So William Sharpe said, hey, let's start with the risk-free rate because that's a great starting point. You can get some positive return without taking any risk. So that has to be the basic starting point. And then we're going to add a slope. We're going to call this the market risk premium, the return on the market minus the risk-free rate. And then we're going to weight that by the measure of systematic risk for that particular company. Remember how I defined systematic risk? It was the height of the rectangle. You get to pick as an investor the height of the rectangle. If you want low beta stocks, you'll invest in companies like utility companies or these giant conglomerates like Procter & Gamble or Johnson & Johnson. If you want lots of beta, if you want lots of height of systematic risk, you'll invest in companies like Apple or Google or Citrix Systems. So we're going to use that capital asset pricing model, you ready for this, as one of our inputs to value a share of stock. Capital asset, we're valuing a share of stock, pricing model. Makes perfect sense. All right, how about if we switch over to preferred stock quickly here. Calculate the intrinsic value of non-callable, non-convertible preferred stock. So this is pretty much the same formula that we just had a minute ago, where we have those dividends. And remember, preferred dividends, they don't have to be, but they're almost always fixed. And sometimes preferred stock has a par value, and you just throw that par value in there as a substitute for the future selling price. All right, here's the big one here. Calculate and interpret the intrinsic value using the Myron-Gordon growth model. Now remember, Myron Gordon was an economist, and he wrote this paper in the late 1950s. And what he did for us is the following. He said, you know what, let's try to value a share of stock. We know that dividend-paying firms tend to pay dividends pretty regularly. They tend to smooth those dividends. So dividends typically don't go like this. They tend to go like this. So Myron Gordon said, you know what, let's assume a constant growth rate in dividends, which was very reflective of dividend policies back in the 1950s. Now, Myron Gordon said, well, wait a minute, we don't have a par value for a share of stock, so we have to have an infinite timeline. Remember, we did this back in our time value of money days. How do you calculate the present value of a perpetual annuity? Suppose it goes on forever. How about a growing perpetuity? Well, that's what this Myron Gordon growth model is. Right? It assumes that dividends grow indefinitely because companies operate as going concerns, which means they're going to be around a lot longer than I am. Way after I die, these companies are going to still be around. So dividends grow over an indefinite period, and they grow at a constant rate. So there's the good formula there for the intrinsic value of the firm. D1 is the expected dividends in year one. R is the required rate of return, which, are you ready for this? We're going to use the capital asset pricing model, all right? and then G is the growth rate. And then, and I give you a good formula for growth rate down there at the bottom. B is the retention ratio, and ROE is the return on equity that we learned back in our accounting days. Now, before I hit the next slide, I want to caution you. Every professor and every organization that asks questions about the Gordon growth model tries to confuse the test takers by giving different inputs in the question stem. So here's what I want you to do. When you get to a question, you're going to get a dividend and you're going to put it in the numerator, but you have to ask yourself the question, is that the dividend 1 year from today, or is it the dividend today? If it's the dividend 1 year from today, then just put it up there as D1. But if it's the dividend today, you're going to have to compound it out like that equation on the far right side of the equal sign. All right, so forget about everything else there, but just note that D1 is equal to D0 times 1 plus the growth rate. All right, here's a good example. So the current, the most recent, there's a hint. For Nike stock, 78 cents, growth rate 4%, required return 8%. What is the intrinsic value of this share of stock? All right, so we're given a dividend. We're going to put that in the numerator and then ask ourselves the question, is this D1 or is it D0? And clearly, in the question stem, we're told that it is the current dividend, so we have to compound that out by the growth rate. So multiply that by 1 plus 4%, and then divide by 8% required return minus the 4% growth rate, and we get $20.28 per share. Now, it's that simple. The math of this is tremendously simple, but don't be confused by the difference between D1 and D0. Now, another part of this is that Myron Gordon always assumed that the required rate of return is greater than the growth rate over an indefinite time period, and that should make some sense. Now, when might it not make sense? Here we go. Let's talk about the two-stage dividend discount model. Are you ready for this? Let's suppose that we have a younger firm that pays a dividend, and let's suppose that this younger firm is going to grow at a high rate. But how long can a company grow at a high rate? Let's take an extreme example. Let's suppose that the executives and the board of directors say something like this. They say, you know what? We have these fantastic and tremendously positive net present value projects. And we think we're going to be able to double the dividend. So this year the dividend is going to be $1, and then it's going to be $2, and then $4, and then $8, and $16, and $32. Well, the question is, how long can a firm sustain that super growth rate? And the answer is just over a short time period. So look at the illustration there. The high growth period is over a relatively short period, followed by a more normal or stable growth rate. All right, so the two-stage dividend discount model is really one in which there's a period of higher growth followed by a period of lower growth. And then the question is, the LOS says, calculate this. How do we do it? Well, we're going to do it exactly the same way that we did before with a regular old Myron Gordon growth model, but we're going to have to make a couple of adjustments. Now, here's a big old formula for you to, oh boy, let's not memorize this thing, but let's just look at it briefly here. What we're doing is we are taking the present value of the high growth period, that's the first part in between the equal sign and the plus sign, and then we're going to take the present value of the stable growth after that period of high growth. Let's go ahead and work through a problem so that you can see that this is not nearly, look at that. I mean, that looks like you just don't want to memorize that. Let's go ahead. I'll show you how easy it is. All right, two-stage dividend discount model. So let's go back to some numbers that we had a little bit before. But let's suppose that current dividend is 78, just like before. But now our dividend growth rate is going to be 4% for 5 years and then 2% thereafter. So this is not really super high growth, but all we're doing is saying we're going to grow by something more for 5 years and then something less from year 5 onward all the way out to infinity. All right, required return is still 8%. What is the intrinsic value of this share of stock? All right, couple of different steps here. So the first thing that we're going to have to do is compute the present value of the dividends during the high growth period. All right, so that's what I have in the numerator there. We got 78 times 1.04, right? That's the higher rate. Then 78 1.04 squared, right? Then cubed, then to the fourth, then to the fifth power, and all divided by 1.08 raised to each of those powers. All right, so there's the present value, that's today's value of the high growth period. All right, how about the present value during that stable growth period? We'll use that formula that I had on the slide just a few moments before. So that present value at time period 5 is $16.13, and then discounting that back to the present value, you get $10.98. All right, so let me do this. $3.49 is the present value during the high growth period. $10.98 is the present value during the high income period. What did I say? The stable growth period. And then if you just add those, you get $14.40. Now, are you ready for a quicker way to do this? All right, I'm going to give you a couple of steps here. All right, this is the way I do it. Now, you don't have to do it my way. I think this way is a little bit faster, but feel free to do it the other way as well. So here I have 3 steps. Find the first normal dividend. So we've got that $78.78. Multiply that by 1 plus the high growth rate, raise it to the fifth power, and then multiply it by 1 plus the normal growth rate raised to the first power. So that first normal dividend is really the dividend in year 6, and that's about 97 cents. All right, and then use that as the numerator in the Gordon growth model and divide by the 8 minus the 2%, and you get that 16,133. Wait a minute, didn't we see that before? Oh, there it is. $16.13. So there's that same number. And then instead of, here, let me go back here. Instead of doing all that, and then doing all that, right, then all we got to do is this. So let's hit our cash flow buttons. So let's do cash flow 1 is 0.811, which is 4% on top of the 78. So all you got to do is put 0.78 in your calculator and then keep multiplying by 1.04. So cash flow 2 is 0.844, cash flow 3 is 878, cash flow 4 is 912, and then cash flow 5 is going to be the 949 plus the 1613, and then I equals 8, solve for net present value, and you get 1446. What do we get back there? 1447. So of course there's just some rounding errors in there. So I'll let you guys pause and try to figure out which of those 2 models suits your learning style better. Remember, it doesn't matter how you solve the problem as long as you get that 1446. How about this LOS? Identify characteristics of companies for which the constant growth or the multi-stage dividend discount model is appropriate. Well, of course, the Gordon growth model is appropriate for dividend-paying companies. I mean, that should make perfect sense. But let's add a little bit more sophistication to this. What we want to do is make sure that those dividends are relatively smooth, so that our assumption that the stable growth rate reflects the reality of this mature business. All right, so these are companies that are not too sensitive to the business cycle, and they are probably in the mature growth phase. Clearly, it wouldn't be appropriate to use this for a non-dividend paying company or a relatively young company that's experiencing massive growth. Of course, if you have massive growth early on, then you use the multi-stage model. All right, next LOS asks us to explain the rationale for using price multiples. All right, so here's our second way to do it. First way, we're using those dividend discount models, right? So now we're going to use some price multipliers to value a share of stock. All right, so what I want you to do is I want you to think of this first multiplier as a price earnings ratio. So look at that first formula I have in the numerator, right? And it has the price. And over on the right-hand side of the equal sign, it has R minus G in the denominator. But what in the heck is that P? So what I want to do is I want you to pause and I want you to look down at the left-hand bottom. And so notice, try to visualize that bottom left-hand formula without the e's, right? So that's just the Myron-Gordon growth model. But suppose I do a little algebra trick. Suppose that I divide both sides by the expected earnings in time period 1, right? Remember from algebra, if you do something on the left-hand side of the equal sign and you do the exact same thing on the right-hand side of the equal sign, nothing changes about the equal sign. All right, so let's go from the bottom left all the way up to the middle. So now the left-hand side of the equal sign is our price earnings ratio. And that's the earnings expected 1 year from today. So that's a forward price earnings ratio. And then we'll substitute D1 minus E1. We'll just use the notation P for the payout ratio, right? Dividends divided by earnings is the payout ratio. Think of it this way. If earnings are 10 and dividends are 4, then you have a 40% payout ratio. All right, so we'll do some substitution in here to try to get the payout ratio and the retention ratio. And all we're doing is some algebraic substitution there. But the important part here is to address that LOS that asks you to relate the trailing PE to the leading PE ratios. And really, I mean, the only difference is the growth rate. The justified forward price earnings ratio is inversely related to the required rate of return, but it is directly related to the growth rate. Now, here's another part of this, is that when firms pay out higher dividends, that means that they have less to reinvest. This is called the dividend displacement of earnings. All right, so lots and lots of dividends early on necessarily means lower growth sometime in the future, because the firm is, instead of investing in positive net present value projects that are going to pay off at some time in the future, they're paying those earnings out to the shareholders as a dividend. How about explaining some rationales here? All right, so this is what we're doing. The method of the comparables, what we're going to do, and there's a big table here coming up in this next one. So what we're going to do is we're going to rely on this law of one price, is that if we have one asset selling in one market and another asset that's identical to that asset selling in another market, well, they should sell for the same price. In addition, that multiplier should, at least theoretically, be related to peer groups within the industry or even peer groups outside of the industry, if that's possible. One of the issues, though, is that it's very difficult to compare companies and industries because companies are unique. You know, there's this, you guys know I like to give basketball and sports analogies. You know, there's this big question about who's the greatest of all time basketball players. Is it Michael Jordan or is it LeBron James? Some people say one, some people say the other, but they played kind of in different eras. And so it's almost impossible to make that determination. I happen to believe that there was a dude who played a long, long time ago might be better than both of those, Oscar Robertson. All right, here's some good multiples. So down the left-hand column, we've got price earnings, price to book, price to sales, and price to cash flow ratios. And then in the middle column are those formulas. All right, so I want you to think about this. What we're going to do is we're going to identify some competitive firms, or some firms within the same sector, or firms that are comparable in many ways. And then we're going to make a comparison of each of these ratios between and among all of these peer group firms. All right, so what can we say? Firms that have low price earnings multiples, they tend to generate higher future returns. And we can make similar conclusions about each of these other ratios. I mean, let's just skip to the price to sales ratio. I mean, suppose that you have a company that has a gigantic price to sales ratio. You know, maybe it's 100. You know, $100 on the floor of the New York Stock Exchange and $1 in sales. Boy, what the heck does that mean? That must mean that investors in general really are attaching a high value to those shares of stock. So the question then becomes, can that particular firm grow in revenues, right? Grow in revenues in the future to support such a high ratio. All right, another way to estimate intrinsic value is through something called the enterprise value. And this is really an interesting concept. I mean, there's a good formula there. So we start with the market value of the equity. We'll call that market cap. Add market value of preferred stock if the firm has any, which most firms don't. And then add the market value of the debt. All right, this sounds an awful lot like what Modigliani and Miller taught us back in corporate finance. That the value of the firm is the value of the debt plus the value of the market value of the debt and market value of the equity. But then what enterprise value does is it subtracts out the top left-hand portion of the balance sheet, because enterprise value is used, now it can be used in lots of instances, but it's used mainly by acquiring firms who want to try to value a target firm. And the reason that we take out that cash and cash equivalents is because if we take over a firm and it has lots and lots of cash, we can use that cash to help finance the takeover. And that's the nature of enterprise value. Now, how about asset-based valuations? This is exactly what the name suggests. It's a value based on the market value of the assets. And so in theory, what this means is that if you take a company like, let's just say Coca-Cola, and you have Coca-Cola manufactures and distributes all of these different beverage products, right? So maybe they have 50 brand product lines. Well, an asset-based valuation model is going to estimate the net present value of each of those product lines. And that net present value, the sum of that net present value, is going to be an asset-based valuation. And so it makes sense then that this is appropriate for companies that do not have a high proportion of intangible or off-the-book assets like special purpose vehicles. Now, how about advantages and disadvantages of each category? What do we like about the Gordon growth model? Well, the thing that I like about it is that it's really simple and it makes perfect sense. Present value of the dividends, present value of the capital gain. It's very useful. It's very useful in estimating the intrinsic value for many, many companies out there that are in the mature life cycle stage. Now, it's probably not too appropriate for companies that A, don't pay a dividend, and then companies that have complex capital structures and very differing leverages and growth rates. Now, the multi-stage model, that has much more flexibility, but it's very difficult to kind of estimate that growth rate during one period and the growth rate during another period. And by the way, there's a 3-stage model and a 4-stage. I mean, you can break it up into hundreds of stages. You don't really want to do that. This reading just does 2. And so it's really difficult to try to figure out, boy, what is this stage growth and what is that stage growth? The free cash flow to equity is very useful because it can be used to value any firm at all. Now, of course, the calculations might be a little bit more complex, but hey, that's what we're training for as good financial analysts. I mean, to be able to compute the free cash flow from equity, this is something that every good financial analyst ought to be able to do, like this. And so there's many more calculations, and it requires a little more subtle approach than the regular old Myron Gordon growth model, because really all we need to do is estimate a growth rate in dividends, and we can use some financial data to do that. Now, the advantages of the multiplier models is that, boy, if we can identify these comparable companies, then we can make some really good conclusions about over or under valuations. Now, this also has some advantages because sometimes it's difficult to estimate. I mean, let's go back here. Free cash flow to equity, suppose the Myron Gordon growth model or the 2-stage dividend discount model. Suppose a company has negative earnings. Well, clearly, if those negative earnings persist, then those dividends are going to be affected. Now, what don't we like about the multiplier models is that there can be lots of mispricing across a given industry or a peer group, so that any conclusions that we make about under or over valuation are misplaced. Asset-based valuation models, these are relatively simple.
They're particularly useful in valuing firms that are heavy in current assets and light in intangibles. And what most good financial analysts do is they use this asset-based valuation to support other models. Like if you use the Gordon growth model and you get a price and then you think, okay, let me go back and do some asset valuation here, and it'll just support or refute some of your prior research. There are some disadvantages here. It's usually not the best standalone option for valuing firms as going concerns. And it's tough to incorporate expected cash flows and earnings or growth rates. And that takes us through this study session on equity investments. Lots and lots of good potential questions come out of this study session. There are some good calculations, so make sure you practice with your calculator. But there's also lots and lots of good describe and compare. Those make great questions on the exam. Compare this thing over here to this thing over here. I'll see you next time.